Step 1. Assessing your current financial situation. Before embarking on any journey toward financial freedom, the first critical step is understanding where you currently stand financially. This is often one of the hardest steps for people, as it requires honesty and an unbiased view of their financial reality. Only by assessing your current situation can you truly begin to make the changes necessary for achieving financial independence. In this step, we'll focus on evaluating your income, expenses, and debts, understanding your net worth, and identifying areas where you can improve. We'll also discuss the importance of confronting financial truths, no matter how uncomfortable they may be. With a clear picture of your starting point, you can make informed decisions about the next steps. Reviewing your income, expenses, and debts. Income, know where your money comes from. The first and most crucial step in managing your finances is to evaluate your income thoroughly. This means looking beyond just your regular paycheck and recognizing that income can come from various sources. By accounting for every dollar entering your bank account, you gain a clearer understanding of your financial situation, which is essential for making informed decisions about saving, spending, and investing. Start by listing all your income streams. For most people, the primary source of income will be their salary or wages from a full-time or part-time job. However, many people also earn additional income from side jobs or freelance work, which should also be factored in. If you're an investor, you might also have income from dividends, interest, or capital gains from stocks, bonds, or mutual funds. For those who own rental properties or other assets that generate passive income, such as royalties from books or inventions, this too should be included. Don't forget to account for any additional income sources, such as gifts, alimony, child support, government benefits, or any other occasional or irregular income you may receive. For example, let's say your monthly income comes from a variety of sources. You earn $3,500 from your primary job, $800 from freelance work, and $150 from dividends on investments. By adding these up, your total monthly income would be $4,450. This gives you a much clearer picture of the full amount of money you have to work with each month. Without factoring in all sources of income, you could miss out on opportunities to allocate funds for savings or investments, or underestimate the amount available for debt repayment. By having a comprehensive view of all your income sources, you can make more informed decisions when it comes to budgeting, setting financial goals, and managing cash flow. It allows you to assess how much money you have available to meet your expenses, build savings, and pay down any debts. Plus, understanding your total income gives you more control over your finances and sets the foundation for a strategic approach to managing your money. Expenses, know where your money is going. Once you've gained a clear understanding of your income, the next critical step in managing your finances is to track your expenses. Without knowing where your money is going, it's difficult to make informed decisions about your financial priorities or find ways to cut costs. Tracking your expenses helps you identify areas where you may be overspending or where money is leaking out of your budget without you realizing it. This awareness is key to making changes that can improve your financial health. Start by categorizing your expenses into two main groups: fixed and variable costs. Fixed expenses are costs that stay relatively constant every month and include things like your rent or mortgage, car payments, insurance premiums, health, auto, etc., and subscriptions, such as streaming services or memberships. These expenses are usually predictable and are essential to maintaining your lifestyle. Variable expenses, on the other hand, are costs that fluctuate month to month. These can include things like groceries, entertainment, dining out, transportation, and any miscellaneous purchases that can vary in amount. To get a comprehensive view of your spending, create a list of all your monthly expenses. For fixed expenses, simply list each item and its cost. These will likely stay the same each month. For variable expenses, you'll need to track spending over time. Bank statements, credit card statements, or a budgeting app can be valuable tools in helping you monitor your spending in real time. Over the course of a few months, you'll get a more accurate sense of your regular expenses and how they align with your income. For example, let's say your fixed expenses include $1,200 for rent, $300 for your car payment, and $200 for insurance. Your fixed monthly expenses would total $1,700. Then, for variable expenses, suppose you spend $400 on groceries, $150 on utilities, $200 on entertainment, and $100 on miscellaneous purchases like clothing or gifts. Your total monthly expenses would be $2,350. By understanding exactly where your money is going, you can identify areas where you might be able to cut back. For instance, could you reduce your entertainment budget or find cheaper alternatives for some subscriptions? Maybe you could shop more strategically for groceries or eliminate some non-essential spending. These small adjustments can help you save money, which you can then use to build your savings, invest, or pay down debt. The more granular you get with tracking your expenses, the better you'll understand your financial habits and be able to make the changes needed to achieve your financial goals. Understanding your debt is a critical step toward achieving financial stability and independence. Debt, when not managed properly, can have long-term effects on your finances, making it harder to save, invest, or make big purchases. To take control of your financial situation, it's important to first know exactly how much debt you have and the details surrounding each obligation. This means taking a deep dive into all your liabilities, from credit cards and student loans to car loans and mortgages. Begin by making a list of all your debts. Start with the creditor name, the lender or company you owe money to, the total amount you owe, the interest rate on each loan, and the monthly payment for each debt. Listing out all these details will help you see a clear picture of your total debt load and how much you're paying each month to service it. For example, let's say you have a $10,000 balance spread across 3 credit cards. The interest rates on those cards might differ: 18%, 20%, and 12%. You also have a $15,000 student loan at a lower interest rate of 5% and an $8,000 car loan with a 6% interest rate. By adding up these balances, your total debt would amount to $33,000. Each of these debts comes with its own interest rate and monthly payment, and understanding the specifics of each one is crucial for developing a strategy to pay them off efficiently. For instance, high-interest debt, like credit card debt, can quickly spiral out of control if not addressed, while lower-interest loans like student loans might not have the same urgency but still need attention. The goal of this process isn't to feel overwhelmed or judge your debt, but rather to gain clarity on where you stand financially. When you have a clear understanding of how much you owe, the next step is to develop a plan to manage and eventually reduce your debt over time. Whether you focus on paying off high-interest debt first, using methods like the avalanche or snowball method, or consolidate your loans to simplify payments, knowing exactly what you owe is the first step in regaining control of your finances. Taking the time to break down and understand your liabilities will empower you to make better financial decisions moving forward, helping you make progress toward becoming debt-free. Creating a balance sheet and understanding your net worth. A balance sheet is essentially a snapshot of your financial situation at a particular point in time, offering a comprehensive view of your financial health. It helps you understand where you stand by listing your assets, the things you own, and liabilities, the debts you owe, to calculate your net worth, the difference between your assets and liabilities. Your net worth is a crucial indicator of your financial health, and understanding it is key to making informed financial decisions. Assets are the things you own that hold value. This can include tangible items such as cash in your bank accounts, your retirement savings, such as 401k or IRA, and the value of any property you own, such as your home or car. Additionally, assets can include investments like stocks, bonds, and mutual funds, as well as personal valuables such as jewelry, art, or collectibles. These assets are important because they represent what you could potentially liquidate or borrow against if needed, and they contribute to your overall financial stability. Liabilities, on the other hand, are the debts you owe. These could include credit card debt, student loans, car loans, mortgages, and any other outstanding financial obligations. Liabilities reflect the money you need to pay back, and they reduce your overall financial strength. Understanding your liabilities is critical because it helps you assess how much of your assets are tied up in paying off debts. To calculate your net worth, you simply subtract your total liabilities from your total assets. The formula is net worth equals total assets, total liabilities. For example, let's say your assets include $2,000 in bank accounts, $10,000 in a retirement account, $5,000 in the value of your car, and $150,000 in the value of your home. This would give you total assets of $167,000. If your liabilities include $10,000 in credit card debt, $15,000 in student loans, and $8,000 in a car loan, your total liabilities would amount to $33,000. Now, to calculate your net worth, subtract the total liabilities from the total assets. $167,000, assets, $33,000, liabilities, equals $134,000 net worth. Having a clear picture of your net worth helps you understand whether you're on the right track financially. If your liabilities exceed your assets, it may indicate that you need to prioritize debt repayment and focus on increasing your savings. Conversely, if your assets far outweigh your liabilities, it may suggest that you are in a strong financial position, which can give you the confidence to invest or take on larger financial commitments. Ultimately, reviewing your balance sheet regularly will help you track your financial progress, identify areas for improvement, and give you a better sense of your overall financial security. Identifying financial leaks and money habits to change. Identifying financial leaks is a crucial part of effective money management. These leaks refer to seemingly small, unnoticed expenses that gradually add up, draining your finances over time without you even realizing it. While a single expenditure may appear insignificant, when compounded over weeks, months, or even years, these costs can have a significant impact on your financial health. Therefore, it's important to carefully track and evaluate where your money is going to identify and stop these financial leaks. Common examples of financial leaks are often tied to habits or subscriptions that are easy to overlook. Unnecessary subscriptions, for instance, can be one of the most common culprits. You might be paying for a streaming service you rarely use, or an app that seemed useful at the time but has since fallen out of your routine. These charges are often small but recurring, and without careful attention, they can continue to siphon money from your account month after month. Another significant source of financial leaks is impulse purchases. These are often daily or spontaneous expenditures that feel harmless in the moment, like buying a coffee on your way to work every morning or grabbing lunch at a restaurant rather than packing your own. While each purchase might only cost a few dollars, these small amounts quickly add up. For example, if you spend $5 a day on a coffee, that amounts to $150 a month, or $1,800 per year. Over time, these habits can divert funds that could be better allocated toward more important financial goals, like saving, investing, or paying down debt. Additionally, late fees are another common financial leak. Missing the due dates for bills can result in penalties, interest charges, or extra fees, which are often avoidable with proper planning. Whether it's a late payment for a credit card, utility bill, or loan, these fees can accumulate over time, making a significant impact on your overall financial situation. By staying organized with your due dates or setting up automatic payments, you can eliminate these unnecessary costs. For example, let's say you consistently spend $5 a day on a coffee. At first glance, it may seem like a small expense, but when you calculate it over the course of a month, it adds up to $150. If you continue this habit for a year, that's $1,800, which is money that could be better spent paying down debt, building an emergency fund, or contributing to an investment account. Imagine the long-term impact of redirecting that money to more productive uses. Your financial situation could improve significantly. By identifying and addressing these financial leaks, you can free up money that can be used more effectively toward your financial goals. Tracking your expenses closely, reviewing your subscriptions, and being mindful of impulsive purchases are all steps that can help you take control of your finances. It's about shifting your focus from small, unimportant expenses to the things that truly matter, helping you make smarter financial decisions and build a more secure future. Setting your baseline. Where are you now? Setting a baseline. Setting a baseline for your financial situation is a critical first step toward achieving financial stability and growth. It's about taking a clear, honest look at where you are right now in your financial journey, without any judgment or comparison to others. This process allows you to assess your financial standing and gives you a clear reference point to measure your progress over time. By setting a baseline, you are laying the foundation for future financial decisions and actions that will help you improve your financial health. A baseline helps you understand your financial reality by considering the full scope of your income, expenses, debts, and net worth. It's important to gather all the relevant data in one place, as this will give you a holistic view of your current situation. By knowing exactly where you stand, you can set specific, achievable goals and track your improvements along the way. Over time, you'll be able to measure how much closer you're getting to your desired financial outcome, whether that's paying off debt, building your savings, or increasing your investment portfolio. For example, let's say your total monthly income is $4,450, and your total monthly expenses come to $2,350. This means you're living below your means by $2,100 each month. This surplus can be allocated toward important goals like saving for an emergency fund, building retirement savings, or paying down high-interest debt. Being aware of this cushion gives you the flexibility to make financial decisions that align with your goals. However, let's say your net worth is currently negative $10,000, which means your liabilities, debts, exceed your assets by $10,000. This is a key area for focus moving forward. By setting this as your baseline, you acknowledge that while you have a positive cash flow each month, you still need to work on reducing liabilities and increasing savings to improve your overall financial health. This baseline helps you track progress in real time, giving you an opportunity to adjust your strategy and stay on track. Setting a baseline is not about judging yourself or feeling discouraged, it's simply a way to establish where you are and create a starting point for improvement. Once you've identified your baseline, you can create a plan to tackle specific areas that need attention. For instance, if you're in debt, you can prioritize debt repayment strategies, like the debt snowball or avalanche method, and set targets to reduce outstanding balances. If you're not saving enough, you can start putting a certain percentage of your surplus towards savings or investments. Having a clear baseline provides both clarity and motivation. It helps you track your progress over time and ensures you're moving in the right direction. It also allows you to adjust your approach if necessary, ensuring that your actions are aligned with your long-term financial goals. The importance of being honest with yourself about your finances. Confronting your financial reality. Being honest with yourself about your finances can be one of the most challenging yet empowering steps toward financial freedom. It's natural to feel some discomfort when confronting your financial reality, especially if you've made mistakes or have fallen into bad financial habits. However, avoiding the truth or sugarcoating your financial situation only prolongs the process of improvement. Acknowledging where you currently stand is the first and most important step toward changing your financial future. The process of being honest with yourself about your finances involves self-reflection. It requires you to take a step back and analyze your past financial choices, good or bad, and the impact they've had on your current situation. This might mean recognizing unhealthy spending habits, such as overspending on discretionary items like dining out, entertainment, or shopping. It could also involve recognizing patterns of relying too heavily on credit cards to cover everyday expenses or accumulating unnecessary debt. It's easy to fall into the trap of ignoring these patterns, but doing so only delays the inevitable need for change. Often, individuals avoid confronting their finances because it feels overwhelming or embarrassing. However, facing your financial reality head-on is the only way to break free from old habits and make positive strides toward your financial goals. Self-compassion is essential during this process. Financial struggles are a part of life, and no one is perfect. It's easy to be hard on yourself when reflecting on past decisions, but instead of focusing on guilt or regret, focus on what you can control moving forward. Financial mistakes are opportunities to learn and grow, not reasons to feel defeated. By accepting responsibility for where you are today, you're empowering yourself to make different choices tomorrow. Everyone goes through ups and downs, And financial setbacks don't define your worth, they're simply part of the journey toward building better financial habits. Completing this step of honestly assessing your financial situation is a transformative act. It lays the groundwork for the important work ahead: managing debt, increasing savings, budgeting effectively, and ultimately building wealth. When you face your financial reality with openness, you gain clarity about the areas that need improvement and the steps required to make those changes. The bottom line: by completing this first step of assessing your current financial situation, you are laying the groundwork for achieving financial freedom. The insights gained from this process will guide the next steps toward managing debt, increasing savings, and ultimately building wealth.